podcast. This is your boy Marcus Norman from Gentleman Style Podcast, your host of the number one podcast coming to you live on all platforms. We are on YouTube, LinkedIn, Spotify, iHeartRadio, and LinkedIn and Facebook, and so much more. If this show serves you, I want to start by doing some housekeeping items, but if this show serves you, please leave a comment, like, and share if you are served by any of these episodes. And please, we are open to feedback here on the show. And so that's it for my housekeeping items. I appreciate you all tuning in. And so as you can tell, we are going to be talking about real estate, but more so a core focus on a specific type of real estate, and we're going to be talking about refinancing, because our goal here on the show is to serve our audience and to serve them in the best way possible, especially during a pandemic and especially during these hard economic times, because everyone is, money's tightening up. Everyone's focused on just surviving and getting through this pandemic. And so my mission is to help get you through the best way possible and the most effective way possible. And so I always want to make sure that these topics are geared towards you and helping you make up a conscious decision. My goal is to arm you with the tools and the knowledge and the wisdom and prepare and fill your toolbox, so when the time beings where you have to make a decision and for your home, you can effectively do so. And so moving right along, let's jump right into this topic. So the good news for you is interest rates are at an all-time low. The central bank has lowered interest rates to practically zero. And what that means for you on the good side is refinancing now can really lock in and dial in a really, really low interest rate on your home, on your primary home. And so it's absolutely crucial. There are many, many people right now rushing to the market to secure good financing and lock in those low interest rates. And what we're going to be talking about here is going to be 3 different things that you can do with the potential savings on locking in a lower interest rate. And that's the point that we want to focus on here, because I want to always effectively serve you through this episode and through this podcast, and ensure that my audience are being helped through and served through this pandemic as we go forward and as we get through this. And so let's dive in. So for the first step here, let's say you have a $500,000 mortgage at a 5% interest rate per year. So per year, for the total for that $500,000, you'll pay over $2,700 for the first year of that mortgage. Let's say you refinance that $500,000 house and lock in another $500,000, same thing, at a 3% interest rate. You're taking that same thing, that same number, and now you're down to $2,100. That gives you a $600 annual savings. Man, that's a lot of money. That's a lot of savings. And so one of the key things that you can do with that money is now you're putting $600 back in your pocket just with a lower interest rate. And I haven't even calculated the fact that you've been paying down your mortgage. So the chances of you refinancing for the same amount is highly unlikely, because you've paid down your mortgage probably significantly since you first owned the home. And so I'm not even counting that. And look at the savings that you're already projected to have based off of the same exact number. So I wanted to start there because it brings up a key point of just that $600. Well, what can you do with that $600? And so the 3 steps is you can save and refinance for the long-term benefit. You can save and invest and refinance to either secondly, lower your monthly payment, or 3, you can refinance and get immediate cash now. So those are the 3 things I want to talk about with the power of refinancing, especially now during this pandemic. So again, the first step is refinancing and giving yourself a financial cushion for the long term and financial success for the future. Refinancing and lowering your monthly payment and freeing up cash. And the third thing is having cash and putting immediate cash right now in your pocket. And so payments and so those are 3 powerful things that tools that I want to share with you, and share the possibilities of depending on what you want to do. And I'm pointing these factors out because every situation is different. Every household is different. Everybody's family is different. So as men, I want to arm you again, your toolbox. I want to put tools in your toolbox. And so you can when the time comes, you can effectively serve your home and make a conscious decision for your home and your family and your loved ones and your friends in the best way possible. So I'm going to start with the first point: most money for the long term. And so what that looks like is refinancing and not pulling any cash out and applying the extra cash to principal. That's right. Taking the extra savings and applying that extra cash, that $600, to the principal balance. And where you can kind of get an idea of this, you want to look when you got your mortgage. There's this thing called an amortization schedule that your mortgage company can provide you. But that amortization schedule breaks down what your monthly mortgage payment actually is allocated to per month. Some goes to interest, some goes to principal. So you may pay $1,000 a month. To give you an example, you may pay $1,000 a month, but that $1,000 doesn't all go to the $500,000 mortgage, the loan that you took on the house, right? That $1,000 does not all go to the $500,000 mortgage, right? It's broken up into several pieces. So you may pay $1,000 a month, but some of that money is going to the principal, which is the original mortgage balance of $500,000. Some of it goes to cover the cost of insurance, because your homeowner's insurance in this day and age is already factored in to your mortgage payment. So what the mortgage company does is, in that $1,000 payment that you make every single month, they take some of that money and set it aside so they can send your insurance company a check annually to cover your mortgage homeowner's insurance for the year. Some of it may go to, and then another piece of that mortgage payment can go to taxes and insurance and mortgage protection insurance, which is PMI. Sometime not PMI, but an insurance protection that protects the mortgage company if you default on the loan. It's an insurance policy that you pay for that protects the mortgage company. If you ever defect and stop paying your mortgage, they can file a claim and get their money back and pay off the balance. And now they own the home and they've gotten compensated and got their money back. So your monthly mortgage payment is broken up into several pieces. And so that is reflected on your amortization schedule. Oh, by the way, some of that mortgage payment also goes to interest. Just the interest, that's the money that the mortgage company is pocketing, and that's their cut of the pie of your $1,000. Forgot to say that earlier. And so what you want to do in that first step is setting yourself up for the long term in the future. And so refinancing is a powerful tool to set you up for long-term success. And you can do that by refinancing. So you have a $500,000 house. Let's say your mortgage is currently $500,000. You refinance. You don't take out any additional cash. You just refinance right now what the current balance of the mortgage is today. You refinance for the $500,000. Don't take any cash out. And now you're saving at the lower rate of 3%, which saves you $600 and saving you on a monthly payment or savings. So let's divide $600 by 12, and that's $50. So you take that extra $50 that you're saving per month and you apply it to the principal balance. And again, the principal balance is the original loan balance of the $500,000 or whatever the current mortgage is that you're refinancing for today. And so you take that extra money and you're just applying it to principal, not to interest, not to the mortgage protection insurance, not to escrow for your taxes and liabilities, but it's going solely to paying down the original loan balance of $500,000 or whatever your current mortgage balance is today. That is setting you up for the long-term success, because what's going to occur is you're going to realize that you're going to pay your mortgage off faster. So if you financed your house originally for 30 years, paying that extra $50 or $100 or $200 a month is going to expedite that payoff, because you're going to get to zero a lot faster because you're applying more and more money to the original loan balance. Well, as your loan balance decreases, your interest rate, whether it be, which is the 3%, is based off of your current loan balance. So if you applied, paid $500, if your mortgage is $500,000, you applied $50 to principal, right? Your new mortgage balance is $4,909.50, right? And so the interest rate is no longer based off of $500,000. The interest rate now is based off of $499,950. It's based off of the new loan amount. And so as you pay down that principal balance, the interest and the money that the bank is making is less and less and less, because you're giving them back their money faster. And that's what you want, because you're now expediting your payment. And that's how you hear about people who have paid off their mortgage, a 30-year mortgage, in 15 years or 10 years, because they had took that extra money that they were saving and they applied it to principal, not to insurance, not to interest, to principal, paying down the original loan balance faster. So that's the first step. Refinancing, taking no extra cash out, no extra cash, and applying the extra savings over the long term to the principal balance. The second step is lowering your monthly payment. So that still involves refinancing. You're not taking any additional cash out. And because you're not taking any additional cash out, your payment is going to go lower. So let's say you've had a mortgage for 10, 15 years, and originally it was $500,000. Well, $500,000 at the 3%. Let's say your mortgage payment was $2,000. Well, if you've been paying on that mortgage for 15 years, the loan balance is no longer $500,000. When you originally borrowed the money, it was $500,000. But when you refinance, you're not going to be at $500,000. When you refinance that loan, it's going to be at a lower amount. And so if $500,000, you were paying $3,000 a month, and you 15 years later, fast forward, the original balance that you owe won't be $500,000 a month. It'll be much lower. It'll probably be, let's say, $400,000, right? So you've paid it down to $400,000. You refinance, not for $400,000, which now lowers your monthly mortgage payment. So now you've now refinanced. Your original loan was $500,000. Your new loan is $400,000. And now your payment was originally $3,000. So guess what's also going to decrease? Your monthly payment is going to go down. Now your monthly payment is now $2,000 because you refinanced it and didn't take any cash out. And now you've just given yourself some extra cash monthly, right? Because before you were paying $3,000 and now you're paying $2,000. So you're pocketing and you're keeping $1,000 extra in your pocket. So what can you do with that extra $1,000? Well, you can do several things. You now have freed up extra money. You've now freed up extra cash, right? To replenish that savings account, to build that portfolio up, your investment portfolio, to reestablish your emergency fund that you may have had to dip into because you lost your job and you was unemployed due to the recession and due to the pandemic. Your original employer fired you. You had to tap into your emergency fund until you was able to find some new employment. Now with that extra $1,000, you're able to replenish your emergency fund. Or maybe you want to invest that extra $1,000 because you freed up the extra $1,000 and you see the economy's in flux. You see the stock markets and everything's on sale. Microsoft, Facebook is on sale, and you want to take advantage of some of these lower price investments. Now, I have to put the disclaimer: you must do your own research before you invest. You want to do research before investing in the stock market. But there's a lot of opportunities in the stock market right now because a lot of businesses are in flux. And so if you, with that extra freed up $1,000 of cash that you now have, you can now invest that, potentially save that, or, dig yourself out of a financially big hole that may have caused you to experience because of this pending pandemic, this recession that we're in. And so my third point is, maybe you just you need an influx of cash. You see an investment opportunity. Maybe you want to go buy some real estate. Maybe you see an opportunity for you to invest some capital, but you need a little bit more right now, immediately, a little bit more expeditiously. Well, you can refinance on that same house. Again, fast forward, if you bought your house several years ago, you originally had a $500,000 house. 15 years later, you refinance that house, and now that house is $400,000. Well, you can now refinance that house. The original loan amount right now is $400,000. You can refinance and pull some of that cash out. That $100,000 of equity that's been sitting in your home, sitting stagnant, that you've paid off, you can now cash it out, refinance your house, take that cash out, and now the bank is going to cut you, or the mortgage company is now going to cut you a check for $100,000. That's yours. Because the house is yours. That's your money that you can now take advantage of with the stock market, with an investment opportunity, or start your own business, or invest in another business. You can invest in someone else's business. Maybe you know of someone who needs an influx of cash, or you know a business that's struggling in this pandemic, and you want to invest in their business to give them a boost. And you can say, now you can negotiate, because now you have some negotiating power and say, hey man, I see your business is struggling during this pandemic. I want to help get you through. I'm an investor. I'll give you $50,000 for 25% shares in your company. Now you're talking like a Shark Tank investor, right? Now you're talking like the big dogs, the big wigs, right? And you're making moves and you're making transitions for the betterment of your family. And so these 3 steps are powerful, and they can give you a step up in the game as you invest, and as you grow, and as you build your real estate portfolio, and as you build your investment portfolio. But again, I'm just giving you the tools so you can fill your toolbox and arm you with what you need to do to fulfill and take care of your home and take care of your family. And so all I'm doing is providing knowledge and tools that will help you be a better man and better in your relationship as you progress through this pandemic. And so, like I said, the first step was refinancing, no cash out, and applying the extra payments, the extra money to the principal balance to set you up for further success, to pay off that mortgage and get to zero faster, which will set you up. Because imagine, again, you have a $500,000 mortgage. You're able to accelerate the payments, because instead of taking that $1,000 of saving, you've refinanced that house. Let's say, again, you originally had a $500,000 house. 15 years later, we're now in the pandemic. You refinance that house. Your house is currently $400,000 because you've paid it down since then. Your house is now today $400,000. You refinance, and your mortgage payment was originally $3,000. Now it's down to $2,000. Now you take that $1,000 and apply it directly to principal, which means your mortgage is going to go down faster, because now you've freed up $1,000 of extra cash, and you're paying and applying that to principal, which is paying your $400,000 mortgage off. Like, instead of a 30-year, maybe it's 15 years you pay it off, or 10 years, because you're applying that extra money directly to principal. And guess what? The unique thing about that is if there's a second, I really like this concept, because if there's a second wave, if there's a second wave of shutdowns, if your new job, because maybe you got fired from your first job, what if your second job, your second employer that you just started with fires you again? Well, because you were smart and you refinanced and you freed up that extra $1,000 of cash, let's say you get unemployed and your second employer lays you off, well, you freed up an extra $1,000 a month. So maybe this month you won't put the extra to principal, right? You just keep it. You keep that $1,000 because you need it. You need that savings. And so you just make your regular mortgage payment and don't apply anything to principal this month because you just got laid off and you need the extra $1,000 to find a new place of employment. But you don't have to redip into your emergency fund again because you freed up $1,000 of extra cash for yourself per month. And so that's powerful, right? That's really powerful. And so it gives you flexibility with freeing up that extra money, and it gives you the ability to ebb and flow as the economy changes and as your situation changes and as your household changes and as your household needs change, right? Freeing up that flexible cash, that cash just from one thing, just by refinancing, it opens up a world of opportunities for you financially. And so, men, these are some of the points that I want to touch on. These are the points that I want to help you build on and fill that toolbox so that you can effectively serve your homes and effectively serve your families. And so if I have served you today, please reach out. Once again, you can reach me at marcusnorman737 at Gmail. I'm on iTunes, YouTube, Facebook, iHeartRadio. I'm on the big Spotify. I'm on the big players. Reach out to me, leave a comment, like, share, subscribe to the show if I have served you today. And gentlemen, like always, take care of your families and take care of your friends and take care of business. This is Marcus Norman, Gentleman Style Podcast, your host of the #1 podcast in America. Good night. Bye.